shares of Alphabet are trading lower again today, coming off the worst day since 2012. Joining us now to break down these different names, Stifel's internet analyst Scott Devitt, who recently downgraded Alphabet to a hold. Scott, where do we start here? I think maybe let's start with that downgrade for Google, for Alphabet, and why you're doing that now.
I think the challenge that Alphabet has is slowing growth. This is an industry that's maturing. Facebook and Alphabet combined are about $200 billion in revenue in 2019 and make up almost 3/4 of the industry. Online advertising as an industry itself is 40% of total advertising. So, numbers are harder to get by. Percentage growth is more difficult to achieve. And at the same time, you have Amazon that's growing into this industry as well. And so it looks like at the moment, Alphabet's the odd one out in terms of growth.
So when you mention Amazon, is the implication here that Amazon is taking some of those ad dollars directly from Alphabet?
That's certainly happening to a certain extent, but to be fair, Amazon's maybe 4 to 5% of the market at this point in time. Facebook is a $70 billion business, now as well, and I think they're also having an effect on Google's advertising revenue. And then finally, Alphabet's been cleaning up the YouTube site from a distribution standpoint, and that's had an effect on growth as well.
Okay, you just mentioned Facebook. We just played some of that sound from yesterday from the F8 Developers Conference from Mark Zuckerberg. This shift towards more privacy, towards more messaging, a bigger focus on groups. What did you think of the details we got?
Well, I think it's good, always staying one step ahead of the law. The company has so many different government regulators in the U.S. and elsewhere after it for its existing business model that it probably makes sense to pivot. The question is going to be, how aggressively the company does pivot, and if it goes, all in on private conversations, it's a different monetization model, and that'll have risk with it as well. We think you'll see a hybrid where there's still a lot of public conversation, which is more easily monetizable from an advertising standpoint, and then the integration of services that are more protective from a consumer standpoint, and the company will have to modify the way that it monetizes those users in ways that some of the Asian companies like WeChat do.
Hey, Scott, you mentioned the YouTube cleanup over at Alphabet. I mean, what's the likelihood that in 2 or 3 quarters we see engagement and ad growth respond to a cleaner site?
It's possible, but I think YouTube is one component of what's happening at Alphabet right now. That, Carl, very much could respond positively once you get through the cleanup period. But the broader issue that Alphabet faces, I think, is this market size constraint and the fact that dollars have to be traded between networks, given how big these networks now are in the overall ecosystem.
Scott, whether we're talking about Alphabet, Facebook, Amazon, I would even throw Apple in there, even though one of those things is kind of not like the others. It seems like we're facing slower revenue growth, at least in core businesses, margin pressure from buying content and from policing that content, and yet valuations are at the high end of their historical ranges. So how long can that keep up?
Well, you tell me how long the 10-year Treasury can stay at 2.5%, and that may answer the question. But I think that we are going through a maturation phase and a heightened regulatory phase as well, which, with a longer duration perspective on these companies, you think would constrict multiple. And so, we have over 20 companies under coverage that I lead coverage on. We only have 5 buy-rated stocks, so we're quite cautious in the current environment.